This is Trepp Wire Week in Review for week ending August 28th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. Joining me are Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, the GOP takes its turn at a virtual convention, and in Texas and Louisiana, there are evacuations. We're seeing a K-shaped recovery come into focus. Core capital goods, a sign of businesses spending, rose slower than last month. Initial jobless claims are once again above 1 million, and Fed Chair Powell says to boost employment, the central bank will not raise interest rates until prices rise faster. All this as some sectors outperform and stocks continue to close at record levels. Meanwhile, we're seeing a drop in new COVID cases and deaths, and positive news on the vaccine front. Manus, in the normal world, if you remember that far back, August results in lighter volume and usually more volatility. Has the pandemic changed that this year?
What I wouldn't do for a normal August, right? A couple of days at the beach, maybe a week off, the Jersey Shore, maybe see a concert at Jones Beach, the Counting Crows or James Taylor, cocktails with your buddies, at an outdoor restaurant. And if you were working, it was the kind of thing where you can come in at 9:30, read the Post till 11, sneak out by 3:30, and
don't forget the nap.
And get the nap in there too. Some days you'd see no trading volume or very limited trading volume. You certainly wouldn't see any deals pricing to speak of, right? There would be no new issuance. Everybody would be lining up their deals on the runway for a post-Labor Day takeoff. But as we know, 2020 is like none other. We did see this week, trading volume has remained pretty high. We've seen as much as 300 million in trading on a given day, which is really unheard of in August's past. We've been averaging probably $200 million a day. People seem riveted by the news right now, which is, again, something that doesn't happen in August. They're following every slice of news on vaccines, on what the Fed is doing, the US and China, economic data coming out. So it's really quite dramatic what we're seeing. And we even saw some deals priced this month, which, like I said, you would normally wait until after Labor Day, but we did see a few pricings. So maybe we'll keep our fingers crossed, and this year it'll be October when we can enjoy a nice summer. We'll have a vaccine in our back pocket, and that'll be the time where we can all go to Europe and other destinations.
Well, remember when we started this podcast? What was it, in March?
26.
Early March?
26 weeks ago or something.
Geez, wow. That's half a year.
Yeah.
We said, a month, 2 months, 3 months, we'll be back. We'll be back to normal and everything will be good. And we're saying that again now. So God willing, I hope that it's actually true. I don't know if rates are ever going to go back up. I know that's recency bias and rates were starting to tick up pre-COVID. But if you're telling me that rates will not increase until we see consistent inflation at 2% or higher, I don't know when we're going to see that. Maybe we get some sort of demand shock on the upside when, we get a vaccine or whatever it may be. But I just think that with technology these days and with kind of the globalization of the supply chain and everything else, like the only thing that's increasing significantly over the last 5 to 10 years in price is tuition and healthcare, right? So I don't know if you're going to see that kind of bread, cheese, and gasoline increasing at more than 2% per year for a significant amount of time anytime soon.
It was interesting this morning. We're taping this Thursday night, and Fed Chair Powell spoke this morning from Jackson Hole, and the immediate reaction was one of enthusiasm. The markets rallied in the immediate aftermath very strongly. They had been flat overnight and rallied when he was speaking and shortly thereafter, with the notion that the Fed will do anything in its power to get this economy back. It won't stand in the way of job creation, even if inflation ticks up. But as the day wore on, the markets kind of labored a little bit. They ended mixed, and you got the feeling that people started looking at it a little bit differently as the session went on, starting to think, what does Powell know that we don't know? Will the economy be slower to come back? And are we facing a big deflationary scenario right now that he's not really letting on? So what started as a great day ended as kind of a meh, but it just underscores what we talked about before, which is this is an August like none other.
Well, it's one of those things where you look at your investment account and things are good. You look at the real world, things are not good. And, my rational, risk averse brain says, hey, maybe we should sell a little bit here. But every time you sell, the Fed comes out and lowers rates or says they're going to keep rates lower, or mortgage rates go to 2.5%. And I think, the only assets with any return right now are assets, right? Not liabilities, not treasuries, not bank accounts, not their stocks and real estate, essentially, unless it's hotels.
Hard assets.
Hard assets, right.
That's right. And you could see that Main Street, Wall Street divide in a way, or the business, the e-business versus the bricks and mortar divide, digging in deeper. From the Main Street side, what we saw this week was the Conference Board's confidence number came in well short of estimates, which, kind of indicates that the consumer is still awfully skittish. That may have something to do with unemployment benefits not, being renewed at this point, and an impasse being between the White House, the Republicans, and Democrats at the moment. There's a little bit out there for bulls to kind of say, we're getting there. And there's an awful lot for bears to say, we have a lot of wood to cut for the rest of the year if things are going to get back to normal.
Well, I wish I owned about 25 homes at this point, because with mortgage rates where they are declining, it's like if I owned a portfolio of bonds when rates were at 5% and then rates go to 2%, all of a sudden my price goes way up. Same thing is happening with houses. I mean, what was it? Almost 25% increase in sales of previously owned homes. And let's see here, 14% increase in July in new home sales, which is the highest in 14 years. I mean, it's kind of absolutely absurd to think about. I guess what that tells me is that a larger portion of the economy is able to work from home and is comfortable enough in their job security that they can make this investment, to purchase a new home. And forget about all the trends of, leaving the cities and everything else, but just having the confidence in your job security to put down 10 or 20% and lock in a 30-year mortgage. I guess that's promising. But I think anything at this point I look at with kind of a little bit of skepticism.
It's really hard to know, how much the impact is of the stimulus and how much of it is true recovery. And I think that we'll be debating this for several months to come. I think that it's really hard to get your arms around this, not only in the broader economy, but also in the CRE economy, as we talked about before.
So if you were me, Manus, knowing where I am in my life, am I looking for a home right now, or am I waiting for mortgage rates to go to 1.5%?
Well, it's interesting. This must be because I'm looking at the Treasury curve 5 or 10 times a day, that anytime I go on CNBC or Market Watch or anything else, I get the ad from Lending Tree. Mm-hmm. It's always out there, and it tells me how much I can borrow and what I can get for a 15-year fixed and a jumbo and a 30-year fixed. And the 30-year fixed right now is 2.46%, which is just extraordinary. I think 2 weeks ago it was about 2.8% or 2.87%. So it's really collapsing. And it's not because treasuries are collapsing. They've been kind of holding steady at 60 basis points for the 10-year, give or take 60, 70 basis points. is because we continue to see, collapse of ultimate yields and spreads at this point. So what would my advice be? My advice would be, tell me if your company is going back in earnest or if you're going to spend the rest of your life in your home office. And if it's the latter, buy something where it's cheaper and you get more land.
I hope my wife doesn't listen to this episode because she wants us to move way far away from the city.
Yeah, you can get, 30 acres somewhere, raise some goats, live off the land.
Grow a victory garden.
That's right.
Anyway, Martha, take us back.
So looking at the delinquency numbers for the month, we continue to see that sectors are struggling. Where are the numbers for August?
So on the overall basis, we saw another nice improvement. We'll be coming out with our numbers over the next day or two for the month of August. As we noted, we hit almost an all-time high in June. We saw a lowering in July. Things really fell hard in July from 10.3% to 9.6% on the strength of a lot of forbearances. It was about 8 billion in forbearances, and forbearances and cures, I should say, that particular month, which drove the rate down. We saw similar performance in August. We saw another 50 basis points or more of delinquency reduction. So we're now in the low nines. We saw modest gains in retail and hotel, not very meaningful. And I think that what you're seeing there is, if you could picture a bathtub at the faucet level, more and more loans are piling in, 30 days delinquent, pushing the level up. But at the drain side, these forbearances are taking some of them out of the denominator, or the numerator, I should say. So accordingly, it's kind of holding steady there. But if we do get to the point where these forbearances end, I think you'd see those numbers go up sharply. In terms of raw numbers, I think we saw 6.5 billion in loans cure last month, either by forbearance or for a borrower reaching into their own pocket. And we saw, if I'm not mistaken, about 4 billion in new delinquencies last month.
I think the number to watch, because of that was a good analogy. It reminds me of junior year high school physics, doing some sort of problem like that. The number to watch, I think, is the special servicing number, because it seems like even when these are quote unquote curing or going to forbearance, they're remaining with the special. So that's 1, 2, whereas before, usually if it cured, it was either getting paid off or it was actually truly cured and it would go back to the master servicer. So I think that number actually has ticked up over the last 3 months based on the dashboard I'm looking at here. But you know what, it's not as, the tick up is not as strong. Last month it was over 1% increase in special servicing. This month it's less than 1%, and loans on the watch list are pretty steady. So, but you got to assume that there is some, third of them are coming out of the forbearance period around now, right? Or in September.
Yeah, what we should do at some point is, what we did see is an uptick this month in both forbearances. We saw a big uptick last month. That number grew this month, although we don't have raw numbers behind that yet. But we did see a nice uptick in requests canceled. And that's a little bit of a double-edged sword. In most cases, I believe they were canceled because the borrower felt the worst was behind them and they didn't want to endure the fees or the paperwork to actually get a forbearance, which would be a really positive sign. But there's probably some in there where the borrower decided, ultimately, I'm going to be giving back the keys on this thing. Let's not dance around this anymore. But I'm hoping that the vast majority are true cures and cancellations, and that's what the data tells us over the next couple months.
In some of the property sectors, we're seeing some specific concentration of news, especially retail, which is an area that we've gotten a lot of attention from both clients and media.
So it's, going back to the data itself, as Joe pointed out, we did see the special servicer numbers tick up in that category and in hotels together. So that remains problematic. And I do think that whatever is curing there is probably doing so either by virtue of an maturity extension or some kind of forbearance. So it remains at the height of our concern list. We did see some mixed bags in terms of earnings this week. We saw on the positive side, Dick's did really, really well. It's a very well-run franchise. I was in a Dick's recently. Much to my disappointment, they didn't have anything that I wanted. Anything that had something to do with a home gym was sold out. So weights, rowing machines, bikes, outdoor bikes, anything like that was just cleaned out. You could have had your endless pick of Rangers and Knicks and Giants and Jets jerseys. Those were not really in high demand. But they do very well and their earnings reflected it. Today, the Gap beat on both the top and bottom line, which is a good sign because they've been really, a franchise of concern for a long time. On the negative side, we saw that Lord & Taylor couldn't find a buyer, and it looks like the Lord & Taylor brand could be going the way of Corvettes and Toys R Us and the Sports Authority and Alexander's and countless other retail names that were iconic at one time or another.
Well, I think it was Dick's Sporting Goods. They had almost a 200% increase in online sales. And I don't know if that included curbside, but there was something in the story about how their curbside pickup was up some ridiculous amount as well. Probably a lot of leggings and Bowflexes and comfy socks, things like that. Anything around the house. It's like the Trex deck, Peloton, Zoom, anything that's to do with your house is, off the charts right now.
The one I find intriguing is the mirror, where you got that guy or that woman yelling at you. Right? It's like a little bit of a boot camp, but they know your name. And, you're doing kind of your speed bag thing, you're punching, you're lifting your legs. And, that has me intrigued. I don't know if I'll ever hang one up or, go for it. But of all the things I've seen lately, that's the one that if I was going to do something like that, that might be it. But, as we all know that, the Mets are doing miserably and the Giants and Jets, their prospects are terrible. The NBA was talking about canceling their season. So I don't have much to stay in shape for. It's just like, back to the Krispy Kremes and no more steel cut oatmeal.
And winter is coming.
Well, if you're the type of guy that worries about, Alexa or Siri listening to you, like, I don't think the mirror is for you. I mean, at what point does that mirror, you walk by that mirror 100 times without actually doing an exercise, it actually turns on and says, hey, fat ass, it's time.
I'd go back to the mirror and I'd say, mirror, mirror on the wall.
I was thinking the same thing.
Fittest of them all, right as Snow White.
Exactly.
My kids could be the 5 dwarfs.
Mirror, mirror on the wall, what's the delinquency rate?
And we saw our often quoted, yet to be on this podcast, Sam Zell calling retail a falling knife. So it underscored, I think, the feeling that we don't know where the bottom is there.
Well, and a couple people who we have had on, Katie and Dan from MP Securitized, they had a huge come up in the New York Times, long article about the Big Short 2.0 and about how they had raised money from Carl Icahn and everything else. So I like to think that we scooped the New York Times on that one, even though, of course, the story had been out there already, and this was just, a rehashing of it, but good on them. I mean, imagine going to an investor or investors and saying, hey, we want to raise a couple $100 million for this, 2 or 3 year thesis that we have, and then calling them up a month later and saying, we just doubled your money. We're going to send it back to you. I mean, you make a career on that type of thing.
That's right. They'll make a movie about it someday.
Yeah, we had them back. We had them on our podcast April 13th, and lo and behold, they were the lead of the New York Times story. So I'm not saying it's our credit, but I don't know.
It'll be
Well,
Ben
I know.
Affleck and Amy Adams, right? Is that what we came up with?
I just like the idea that if they buy one of those 360-foot yachts, that they invite us on it for a spin around Manhattan someday.
Let's hope. And if we go overseas a little bit to the UK, the multinational retailer Debenhams, as they say, is battling to keep jobs and outlets by fighting what are increases in their rates bill. Can you give us a quick rundown of what is going on there?
Sure. So our colleague Vivek, who we had on a few weeks ago, sent us some of these news stories, and I had to ask him, what the heck is a rates bill? And apparently it's the way that property taxes are assessed over there, similar to the way we do it here. But the problem is that in the UK, the last time that commercial real estate properties were valued was in 2015. And if you haven't realized, since then, Brexit has occurred, which has decreased the value of most commercial real estate properties in London and the UK. And now, of course, we've got the pandemic happening. So it seems like Debenhams is a large, old school, storied retailer. And they are, I don't know if there's a good analogy, but they're taking Swansea to court and trying to kind of appeal these rate bills. So we'll see how that goes. I think, we might have to have Vivek back on to actually explain what the heck all of this means. But I wouldn't be surprised if you saw similar stuff happening in the U.S.
We also saw Pret a Manger, which is a to-go coffee and breakfast and lunch place for those that
It's been a
don't
while
know.
since we had a French retail name.
Yeah.
I was a big, they're popular in London. You see them everywhere. And they were growing over here. They had a really nice almond croissant that I'd get every now and then in the morning. And the coffee was self-serve. I didn't care for that quite so much, but especially because the things were always empty. You go to pull
That
one
was
of
the
the handles
worst.
and it was empty. But they have now pulled out of Chicago and I believe Boston, if I'm not mistaken, leaving them with presences, I think, in New York, Philadelphia, and one other city. But the British can't get a break these days.
Yeah, they were a great grab and go back in the day when we were in the office. Nobody's doing that anymore.
The croissants were always warm, which I loved.
And you were talking about valuations. It reminds me, we had a great interview with Fritz Kagi, the Cook County assessor this week, who talked about creating valuations with a data-driven approach. And I think, he's a tax man, but he was interesting.
It was a great interview. We got to talk about the White Sox, for whom he's a big fan, how he got his start in the business. Just a real pleasant guy to talk about. But I'll give an early shout out right now because one of our listeners told us we missed a great opportunity for a question. Yinzer Dave, also known as Steel City Dave, told us that the big miss was not asking him about a previous Cook County assessor, which would be Steven Spielberg, who played that role in the 1980s movie Blues Brothers with John Belushi and Dan Aykroyd. It had cameos in that movie from James Brown, Aretha Franklin, John Lee Hooker, Cab Calloway, and Ray Charles. So it's great to watch these people trying to find out where they pop up, even a young Shaka Khan. But one of the characters was a young Steven Spielberg as the Cook County assessor. And I do wish that we could have gone through that riff. Dan Aykroyd being a Chicago guy and the movie being iconic, it would have given us even more to talk about earlier this week.
You just mentioned a bunch of names that a lot of people don't know.
Our millennial listeners won't know anything about that unless they're older millennials who happen to catch the Blues Brothers late night on like TBS or something like that. But didn't they have to? They had to like run around the city to get money to pay the assessor to save the nun's house or something.
It was a mission from God they were on. They had to raise the money to Right, to keep the orphanage or the church or something from being foreclosed upon.
Right.
So,
It was the orphanage that was run by the nuns where they grew up.
right.
Right. It was like Happy
Iconic
Gilmore.
movies, so worth it. And you see, next to Animal House, perhaps John Belushi's finest performance.
Well, I'll say, the interview with Fritz was very interesting. I think it was very cool to hear the ins and outs of what you would think is a relatively nerdy and boring topic, but the way that Chicago or Cook County does their property taxes is slightly different than a lot of other places. And it actually seems like a reasonable way of doing things if you are able to, value everything correctly on a fairly regular basis, which is really the hard part. And I think that one of the key takeaways was that, Fritz and his group are modernizing their approach. And that means that they are much more well equipped to value things correctly and on time. And I think that they're definitely ruffling some feathers out there, because the old way of doing it was the old way of doing it, right? And there was probably a lot of buildings that were valued much lower than what the true market value was.
Yeah, I would call it flying without radar before the assessors really started taking to a more data-centric approach. It's an interesting dynamic. Hopefully it leads to more fairness, as Fritz said, over time, and less randomness in valuations.
So the only other, we're giving a lot away, so go listen to the dang thing. But my favorite part was when Fritz said he gave up his children's souls to make them White Sox fans. So you gotta that's a little teaser. You gotta listen to understand what I mean by that.
If we look at the office sector, which has a delinquency rate that's still relatively low, the debate over when is the right time to return to the office continues to play out.
The time is nigh. Well, we had all sorts of points and counterpoints coming across the wire this week. One was from the CEO of Related, who had a Wall Street Journal op-ed saying that, the heart and soul of New York City and Manhattan will not be, recovered until the city's workers come back to work in their offices. I thought he made some good points about, we relied on essential workers, firemen, policemen, doctors, nurses, delivery men, Con Ed guys, garbage men, this whole thing. Like, they had to go to work this whole time. And, it's time for us, high blue and white collar people to start doing our part. I thought that was a fair assessment. On the other side of the coin, you had Ford coming out and basically giving in to the fact that they don't think they'll be back fully in the office for a while, and they're using that as a reason to kind of rejigger a lot of their office space. They're saying that they're not going to downsize their space or downsize their employees, but we'll see if that's true. And then we had, was it Zell, who said, it's get your ass back to the city, get out of your place in the Hamptons. It's time to get back to work. Listen, who knows? You can't make broad statements without offending somebody, but I'm kind of on their side a little bit. Like, we have to start somewhere. And given the, at least in New York City, right, given the very, very low incidence of cases and fatalities and everything else that are happening due to COVID right now, it wouldn't be the craziest thing in the world to start kind of trickling back into the office. And, did you see Seinfeld's piece this week? So, that whole New York City is dead forever op-ed piece that was floating around the internet this week. So he had a response. Seinfeld had a response that says, "Are you crazy? Like, this is New York City. It's not dead." Like, and he went through all the things that have happened in the past and how New York City has always come back, and big cities in general have always come back, which I guess I generally agree with. But you have to listen to Downtown Josh Brown's podcast, because he knows the guy who wrote the New York City is dead piece. And he says, this guy just knows how to get clicks on the internet. And he goes through this whole thing. So anyway, end of my diatribe.
Well, I would say that, whenever we face crises like this, normally they're in the form of war, right? The best of us come out, and the best of us come out in many ways, right? The able and the courageous are the ones storming Omaha Beach and Utah Beach and Juneau and so forth. And then there's a whole another segment of the population, Rosie the Riveter, that's back in Detroit making tanks in the absence of auto workers instead of Cadillacs, right? And I feel like we're in that point now. And of course, there's people in every time that can't do either, right? They're elderly, they're affirmed, and so forth. But in some ways, this COVID is the same thing. And there are some that are capable of working in a lab in Cambridge or in New Jersey or somewhere else whose critical mission is finding that vaccine or that faster test or something else. There are some that bring nothing more than youth and health to the mix. And it's really important that those people, office workers, teachers, whatever, show the same courage that their predecessors did, and show up in the office, show up in the classroom, and carry the burden for not just themselves, but for those that can't answer the call, the elderly, the infirm, the sick, and so forth. And I've been a big proponent, a big believer of the fact that despite some of the negatives we see in this country, we are a country of courageous people and principled people and strong-willed people. And I think just like the doctors and nurses stepped forward, and truck drivers and delivery people and, supermarket workers for the last 5 months, I think that those that have to do the next round of things will. I don't think that we are a cowering bunch as much as, sometimes the media, tends to portray people at either end of the spectrum that are the outliers. I think by and large, we have fortitude.
So that brings us very logically to our shout outs segment, where we give a shout out to those who have reached out to us either via email or some other channel. We've got a few this week.
So we already shouted out Steel City Dave. Thank you, Dave. We got one from James E. Thank you for checking in. And we look forward to talking about some of your questions in the near future. GS from Long Island, he had a question on loan bifurcations, which was our educational segment last week. And I did promise him a data-filled reply by the end of the week, and I haven't forgotten about him. Greg W. said that travel and hotel activity in the areas that he's been lately has been bumping. That would include the Outer Banks and Vail, Colorado. I would have to underscore that. I spent last weekend in Asheville at the Omni Grove Park, which is kind of a big conference center. It has an enormous number of rooms. I think it has 6 or 8 restaurants, golf, a spa, and so forth. And that place was filled to the gills. People were respectful. They had their masks on. They were being careful, but the restaurants were loaded. People were hiking. People were playing golf. The valets were doing great business, and it was a very positive sign. I would say it was quite encouraging. And it goes hand in hand with what we were saying recently, that we think that the drive-to destinations, of which all of those would be, Vail, the Outer Banks, and Asheville would all fit that bill. We think that they're probably doing pretty well right now. I'll give out one more.
I will say that golf is off the charts in Westchester County since this pandemic thing has hit. I've never seen, well, first of all, the New York City courses were closed for a long time. So we had a lot of New York City people coming up to all the public courses in Westchester. But, I've been playing for 10 years. I've never seen the courses this full. And I think just like you've never seen so many people just walking around, right, outside, because people are just dying to get outside. And so I hope it's a renaissance for golf, actually. It'd be good for me.
The last shout out goes to SB. Last week, we noted that several colleges had gone fully online. In some cases, sending kids home we encourage anybody with specific insights into the matter to feel free to reach out. So SB did, with some thoughts about UNC. He gave them high marks for preparation with all their protocols and so forth, but said that, you know, all the colleges are swimming upstream trying to keep 18 and 19-year-olds apart. And that's a great point. We probably didn't give that enough oxygen last week, that it's a thankless job, probably kind of like being a daycare worker with an oversized class and a couple people calling in sick. But separately, it turns out that SB is a longtime CMBS guy going back to the RTC days. So we traded some great old war stories. He worked on the old Con-Fed deal, which for those that entered the market after the year 2000, it was the first huge CMBS deal. 800 loans, $2 billion, unprecedented for its time. It came with a prospectus that had an Annex A that was not electronic. To fold it out was like opening up a Texaco roadmap to get all the data. The people at Trepp that had to enter the data were going out of their minds trying to, you know, one by one enter state and city and zip code. It had to be done 3 times because the error level was so high. The deal was a portfolio sale deal. It was put together by Lehman Brothers. Trish Hall, one of our longtime friends in the industry, will remember that deal. It was known as SASB 1996 CF on the Bloomberg screens, and it was a bear. It was a bear to model. It was a bear to enter data for, but it was one of those deals that was the wedge, just like some of the Nomura deals, the mega deals, that helped the market kind of wrestle the processes down to the ground. But I'll never forget that roadmap like Annex A, and nor will the people that were entering it at the time, who were left to stutter gibberish after 3 days of entering zip codes.
They were the ones that moved up to northern New York and became shepherds after you made them do that Annex A stuff.
Right, they were monks.
They never touched a computer or an Excel spreadsheet again.
The Texaco roadmap reference, it came because I was listening to some Bruce Springsteen before, and I was listening to the song Open All Night, in which he talks about the Texaco roadmap. And that gave me the metaphor for what
That's a visual.
It's a great song. I love it. It's from the Nebraska album, but it gave me the metaphor of, you know, for older guys like me, picturing your dad with that map open on the hood of the car, trying to figure out how to get from, you know, Western Massachusetts to Eastern Maine on side roads, as Keegan could probably attest, Air Portland, that, you know, that's the only way to do it back then. And it was a struggle.
So it is time for the music deal of the week.
Deal of the
Yes, we haven't gotten the cease and desist yet from ESPN, but I guess it's coming one of these days.
They're waiting for us to hit 100,000 listens.
That's right.
Close. We're very
happen.
close.
We're getting there.
In August, you don't see a lot of activity, as we mentioned earlier, but we did see some things this week. And like we said earlier, 2020 is like none other. We wrote about this first one in Trepp Wire a week or two ago, that pharmaceutical firm MSA had signed a 330,000 square foot lease in Nutley, New Jersey. We believe it was the biggest New Jersey office lease of 2020. The new lease is owned by a property owned by Prism Capital, known as ON3 is the name of the property. It used to be the headquarters for Hoffman LaRoche. The folks at Prism, and thank you in particular to Ido, who gave us the names of the brokers involved.
I'm gonna guess it's Ido.
Ido.
Agreed.
Okay.
Agreed. It's okay.
Shame on me for that.
Shame on you.
And yes, I don't like getting names wrong, but thank you for correcting me. The building owner was repped by the Cushman team of Robert Rudin, Bill Brown, and Josh Cohen. Asai was repped by the Seville's team of Greg Najarian, Dan Foley, Chip Conklin, and Nathan Borozowski. Congrats to them on getting that over the finish line. Just a sign that some people are willing to sign on for long leases, even in the midst of troubled times. The next one was MyTech, a residential and commercial supplier. It expanded its footprint by 35%, 150,000 square feet in Tolleson, Arizona, at an industrial property owned by CalSTRS. MyTech was repped by Don McWilliam and Chris Reese of Colliers in Arizona, and Kevin Gallagher of Colliers St. Louis. CBRE's John Wursler, Cooper Fratt, and Pat Feeney repped CalSTRS. And then lastly, in England, in Essex, England, meal kit provider Gausto pre-leased nearly 200,000 square feet of cold storage from CBRE. The facility is called Chillbox, and it hovers around 1 degree Celsius, within plus or minus 1 degree. That was part of their marketing material, so it's very consistent in their cold temperatures. It's a 10-year lease. It's wonderful, so they'll lock in for a long time. Sovereign Centos, DTRE, and BNP advise CBRE, and Sean Galvin of SBH repped Gausto.
And we
Wow.
had
Kudos to you, Manus.
that was
Yeah, but I
box.
got the big one wrong. You know,
That's
the
okay.
first one. You want to get that first name right.
And you had we have a green shoot you want to highlight.
We did have a green shoot. It was FTI Consulting taking 120,000 square feet at 1166 6th Avenue. The property is Midtown West, the Midtown West segment of Manhattan. So another very positive sign, a vote of confidence for the New York market. It's a 15-year term, so a long lease. Asking rents were $80 a square foot. We don't have the reps on either side of that. It is a Minskoff building, but if those that were involved want to send those along to us, we'll give shout outs next week so we can complete that loop.
So we also published our secondary MSA report, and secondary MSAs are those that employ between 1 to 2 million, and they're also known as 18-hour cities. What did the ranking look like, Joe?
Sure. So nothing super surprising. I mean, Austin tops the list. You see all these memes on social media now about how unoriginal it is to move from San Francisco to Austin and how everybody's doing that. I think actually Kevin Durant on another podcast that I listened to mentioned that he went to UT and played basketball there before he went to the NBA. And he said since he was there, every time he goes back, it looks more and more like San Francisco. So it's definitely a big hipster vibe there, and that's benefiting them big time. This report looked at weighted average DSCRs, delinquency rates, occupancy rates, volume growth, so growth of the debt market in general in that area, population growth, unemployment rate, and lodging and retail exposure. So I think the lodging and retail exposure was a counter indicator of the ranking. So if you look at the list, you see in terms of Texas, you see Austin, you see San Antonio. In California, you see San Jose and San Diego high up on the list. You don't see a lot of cold weather places. I think that's one of the things I noticed towards the top of the list. Orlando's at 9, Charlotte's at 7, Vegas is at 6. So a lot of good data went into this, and it's actually something that we started doing several years. I think Karina, our old analyst who has since moved on from Trepp, she originally did this piece. So if you're listening, Karina, good on you. We're still using some of your queries.
Austin's mantra, if you've ever been there, they have the t-shirts which say, keep Austin weird, right?
Yes.
They don't want this influx of outsiders to change the culture. So, you go, Austin, keep that freak flag flying.
I think the first thing I want to do if I go to Austin is go to one of the roller derbies. I think they have a big outpost of women's roller derby down there.
I would pay to see that.
I'm keeping my fingers crossed that the music festival comes back, right? Also known for great music, and can't get live music back fast enough, in my opinion.
All right. So turning to our story that we've been following for the last few weeks, we're ready to publish a deep dive report that's an analysis of the variances in net operating incomes, comparing the underwritten and actuals. Do we have a preview that we'd like to share?
Yeah, I think we're right on the 5-yard line. We're putting something out very soon. We think that it's an important piece. For those that don't remember, about 2 weeks ago, the Wall Street Journal published a piece about the CMBS market, suggesting that lending practices had been aggressive, bordering on inflating NOIs for loans originated after 2013. The study was done by 2 University of Texas professors. They looked at the first year of NOI and net cash flow numbers, or NOI, I should say, after issuance, which we thought was too limited. We think it needed a broader view because nobody underwrites a loan with just 1 year in mind. We thought that for the integrity of the market, a real deep dive had to go in this to really look at this objectively, looking at all the numbers and so forth. And what we're putting out very shortly is a review of all conduit loans issued between 2013 and 2019, and looking at NOI versus underwritten cash flow, underwritten NOI, and looking at how they compare. And it's an interesting report. We hope that people, once it comes out, downloads it. It will segregate performance by originator, by property type, with distribution analysis as to how far certain parts of the market surpassed expectations or missed. The numbers are more favorable to the market than they were from the UT perspective. We do think that this is part of a process that should be repeated annually as part of good hygiene. You could always take new ideas. I think the CMBS market has been extraordinarily transparent over its 25-year history. Adding this as a metric going forward is another form of good hygiene. I think that, by the way, we don't shame anybody. We list the originators by originator 1, originator 2, and so forth. So people can remain anonymous, but we do think that for those banks that want to do deeper forensics, it's a good task to try to underdo. You'll see areas where you've overperformed and areas where there's probably room for improvement.
One of the more important things is to we were making sure that we're getting these numbers right, and showing the distributions. And there are loans that underperform underwriting, and there are some loans that underperform their underwritten NOIs fairly significantly. We don't have to go through it all again, but we've talked about how if we spent the time to go through one by one every single loan, and if you remove the ones where there was a pre-specified reason for it, and it was reserved for, and it was footnoted, then that's something that you should basically remove from, the negative bucket, I think. We didn't go through to that level, although I do know that some banks would actually do that on their loans alone. So I would say that, the percentages that we see with our method are not as high as the UT study showed in terms of how many loans are underperforming by greater than 5%, the underwritten amount.
I would say that there's 2 points that I would make. Point number 1 is that it's not just necessarily a negative to do a deep dive and look at forensics. Yes, that's a useful endeavor to say, wow, we've done great in multifamily and great in industrial and great in office, but we had some stinkers in retail or lodging. I think that's great hygiene for a bank to perform. But there's the other side of the coin, which is the opportunity for more market share. if you are lending on properties that regularly outpace expectations by 15 or 20 or 25% in the first 5 years, you're probably being too conservative. You're probably not giving your borrowers enough credit in terms of proceeds for what they might have gotten. And it might be a way to look at this thing afresh and say, we can be a little bit more accurate
right?
in our methods and maybe gain more market share in that capacity. Point number 2 is anybody running a portfolio of loans or a portfolio of stocks or even a horse racing farm, right? Nobody's expecting to bat 100, right? If you're batting 100%, you're probably not taking enough risk. And so whether you're a B-piece buyer, an originator, or even a CMBS lender, that some percentage of this portfolio is going to go delinquent. So anybody who expected this study to come up with something which said, in the baseball metaphor, you batted 1,000 or you went undefeated in the football season, right? That would be somebody who doesn't really know the commercial real estate markets, right? That just doesn't happen.
We also published our LifeComm's commercial mortgage index showing a swing to positive total returns in the second quarter. What did that look like, Joe?
Yeah, just came out this week. We saw a total return last quarter. Q1 2020 was actually a negative 1% total return. And in Q2 2020, it was a little over 4.5%. Doesn't sound super sexy when we're talking about 30% increases in home sales and giant swings in GDP and everything else. But these are generally main on main, Class A stabilized commercial real estate loans, low risk, relatively low risk. So having a swing like that when the normal total return in any particular quarter is, under 1%, it was a big swing from last quarter to this quarter, just like everything else we've seen in the economy. So we do a couple more deep dives or breakdowns. Obviously lodging, not so good. Multifamily, industrial, office had pretty good quarters. Retail actually had a positive quarter in terms of total return. And, some of that is due to treasuries dropping, right? So, these loans that have fixed rates, their values do increase when basically the discount rate decreases. So take a look at that, do a little bit of a deeper dive on some of those granular topics.
And if we turn to corporate CLOs, we've talked about the challenges with schools reopening, and Aramark, which provides food service to schools, saw its revenue drop by 46% in the third quarter. Should investors in CLOs be concerned here?
It's an interesting dichotomy, if you will, for the stock versus the leveraged loans. The stock is off more than 50% this year. Aramark has a big student cafeteria program. They have a big contract, as Barron said, in their article this past weekend, with the city of Chicago. So the stock has taken a hit, and obviously equity investors see some concern there. Yet the CLO presences, the leverage loans, do not reflect that. They're all trading in the mid to mid-high 90s, 95s, 96s, even though they have a really skinny spread of only 175 basis points over LIBOR. In total, there are 3 separate loans totaling about $4 billion. So it's hard to imagine, in some ways, both being right, that the equity could be down as much as it is without it reflecting more pain that is currently reflected in the loan side on those credits.
Well, what's really hard to imagine is that there is a company that is large enough to have billions of dollars of debt outstanding by serving Elio's Pizza, right? I mean, I remember, I'm going to do one of those old soul millennial things here and say, I remember when in 4th grade, my lunch was 50 cents. And I have very fond memories of the lunch ladies scooping that sloppy Joe into the tray maybe if I remembered to bring another quarter with me to school, I could get a fruit roll up or one of those little plastic quarter waters, like the little grenade thing that was just probably like made in the back of some bodega with water and sugar. But anyway, that has nothing to do with Aramark. You brought me back to my early days of lunch dates.
Well, there's probably a special place in hell for me because I had a phase, I don't know if you remember this, but they would put out these little pastries and they'd pour something over it. It was called Fish Newburg. And it was just kind of like a soup over a crust. And they would just put it on a plate and the kids would come and grab it off the plate. And I had a small phase from my youth where I used to sneak out the little cups when they weren't paying attention, and I would fill them with things other than emptiness, right? I would fill them, and I would make them kind of like a tart. I'd put some yogurt over it, maybe some fresh fruit, and I'd put it back on the dessert line, but it would still have something in the middle that was not desserty. So, back when I was into, running some practical jokes, that was
grammar school hijinks.
Yeah, grammar school. So somebody would bite into it, think it was a nice little tart, and in the middle would be like that mystery meat.
It would be the sloppy Joe.
The chicken roll, which wasn't really chicken and it wasn't really a cold cut. It was like, the press board or the plywood of the cold cut chain.
The plywood of the chicken genus.
It goes right with the cream donut story, Manus. So with that, we are closing this episode. Thanks to our producer, Keegan St. Ange. Join us next week. We'll look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send it to our email at podcast@trepp.com. And for more info, visit trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.